$300,000 gone. Not to a scam, not to a bad stock tip, not to a divorce lawyer, to a combination of three ordinary-looking decisions that almost every American retiree makes without blinking. And here's the part that should concern you before we even get into it. The $300,000 number is actually conservative. For a lot of people, I'm going to show you it's closer to $450,000 once you run the full math across all three mistakes simultaneously. Stay with me because the numbers get genuinely alarming and then they get fixable. Let me start with what this video is not about. It's not about picking the wrong stocks. It's not about failing to max out your 401k. Those are real problems and I've covered them elsewhere. This video is specifically about the moment you shift from saving to spending and the three silent traps that destroy retirement portfolios, not during the saving phase, but right at the transition. The accumulation years forgive a lot of errors. The decumulation years forgive almost none. That asymmetry is where $300,000 quietly disappears. I want to give you a central image that I'll come back to throughout this video because it's the most accurate picture I've ever found for what actually happens in retirement. Think of your retirement portfolio as a bucket. You spent 30 years filling that bucket. You were disciplined, you saved, you maybe got lucky with some market gains. Now you're 65 and you've got a full bucket. The standard advice is, great, now carefully pour from the bucket at 4% per year and it'll last 30 years. Simple, elegant, wrong, because the bucket has holes in it, 3 of them. And each hole is draining your bucket while you're still pouring from the top. A full bucket with 3 holes doesn't last as long as a slightly smaller bucket with no holes. That's the entire thesis of this video. Not save more, not invest in better things, fix the holes. Here's what I'm going to cover. Hole number 1 is something most people understand exists but dramatically underestimate in dollar terms, and I'm going to show you the actual math because it's offensive. Hole number 2 is something most financial advisors will tell you about but won't tell you how to fix because fixing it is bad for their business. And hole number 3, I'll get there, is arguably the single largest avoidable financial decision of your life. And over 90% of Americans get it wrong. Before I get to that third one, I'm going to tell you about a guy I'll call Marcus. He's going to matter later. In a few minutes, I'm going to show you a scenario where 2 people retire with the exact same portfolio, the same average returns, the same withdrawal rate, and end up with completely different retirements. One of them runs out of money 8 years earlier than expected. But first, let me show you something even more broken than you probably think. Hole number 1, the sequence problem. There's a piece of research by retirement economist Wade Faw that I want to sit with for a second because it reframes everything. He found that approximately 77% of a retirement portfolio's final outcome can be explained by the average return of just the first 10 years of retirement. 77%. That means the entire back half of your retirement years, 11 through 30, accounts for less than a quarter of your outcome. The early years do almost all the damage or almost all the good. This is not intuitive. Every diagram I was shown as a kid of how compounding works implied that time smooths everything out. It doesn't. Not when you're pulling money out at the same time the market is falling. Here's the parable version of this. 2 brothers, let's call them Robert and Frank. Both retire at 65 with $1 million. Both plan to withdraw $50,000 per year. Both end up averaging 5% annual returns over 20 years. Identical in every measurable way except one. Robert retires in 2009, right after the market has already crashed. Frank retires in 2007, right before the crash. Robert's early years are good. Frank hits losses immediately while writing checks to cover his living expenses. Frank has to sell shares at the bottom of the market just to pay rent. Those shares are gone. They don't participate in the recovery. When markets fall in the early years of retirement, you're forced to sell more shares to fund the same withdrawal at exactly the wrong time. Those shares are gone forever and can't participate in the eventual recovery. Frank runs out of money years before Robert, even though both average the same return. The average doesn't matter. The sequence does. Morningstar found that nearly 70% of retirement plan failures in their simulations involved cases where the retiree's investments had lost value by the end of year 5 of retirement. Not year 15, not year 20, year 5. The first 5 years of retirement are where portfolios go to die. If you made it through the first 5 years of retirement with investment gains, there was only about a 1 in 25 chance you'd subsequently deplete your savings before reaching the end of retirement. That's a 96% survival rate if you get lucky in years 1 through 5. A coin flip if you don't. You think the problem is not saving enough. The actual problem is not protecting what you saved during the most vulnerable window. That window is roughly the 5 years before you retire and the first 10 years after, what some researchers call the retirement red zone. This window is sometimes called the retirement red zone. During this period, your portfolio balance is at or near its peak, and losses have the longest time to compound against you. What's the fix for hole number 1? This is important because the mainstream advice here is genuinely useful for once. You build what's called a cash buffer. You keep 1 to 3 years of living expenses in liquid form outside of your equity portfolio. Maintaining 1 to 3 years of living expenses in cash or short-term bonds means you don't have to sell investments during a downturn. This gives your portfolio time to recover without locking in losses. It's not glamorous, it's not complex. It's a fire extinguisher. You don't think about it until you need it. And if you need it and don't have it, you're selling shares at 60 cents on the dollar to pay for groceries. Stay with me because the next one is more personal and more fixable, and it's where the real money gets destroyed. This is where it gets really interesting. Hole number 2, the fee hole. This one makes me genuinely tired. I've been watching this play out for years among people I know, among clients my accountant friends describe over lunch, and the math is always the same. The fees look like nothing on paper. They feel like nothing. They destroy everything over time. Here's a story of 2 investors. Same $100,000 starting balance. Both invest for 30 years. Both earn the exact same 8% gross annual return before fees. The only difference? One investor is in a low-cost index fund charging 0.05% per year. The other was sold an actively managed fund by a friendly financial advisor at a seemingly reasonable 1.25% per year. After 30 years, the index fund investor has over $1 million. The actively managed fund investor has about $685,000. The difference is a staggering $321,418. Let that breathe for a second. $321,000 vaporized. Not by a bad investment decision, not by a crash, by a fee that felt like basically nothing every single year. That's the double whammy of the investment fees impact. You don't just lose the fee, you lose its entire future. Here's what makes it worse. That 1.25% number is not an extreme example. The asset-weighted average expense ratio for equity mutual funds fell to 0.4% in 2024. But the unweighted average remains 1.1%, indicating most investor dollars migrated to cheaper funds, while expensive funds persist. In plain English, the cheap funds got cheaper. The expensive funds are still expensive. And millions of people are still sitting in them, often inside their 401k rollover IRAs, paying fees they don't see and don't understand. Because fees are taken out of invested assets, the impact of higher fees compounds over time due to reduced growth. Previous research has found that many people don't read fee disclosures, or if they do, they don't understand them. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now, here's what I find genuinely absurd about this situation. The mutual fund industry has had a 40-year data war against itself, and the cheap side won. They called it Bogle's folly. They said being average was un-American. Yet decades of data have proven Bogle right. The vast majority of active managers fail to beat their benchmark index over the long run, especially after their higher fees are accounted for. You're paying extra for someone to underperform. The most expensive fund in your 401k is almost certainly not the best performing fund. Morningstar data shows expense ratio is the strongest predictor of future returns. Cheaper quintiles beat expensive quintiles 2 to 3 times more often across virtually all categories. This is the part where most people say, okay, but I'm in a target date fund, so I'm fine. Maybe. The average target date fund expense ratio was still 29 basis points as of 2024, which compared to a 3 basis point Vanguard S&P 500 ETF, will still cost you a meaningful amount over 30 years. Not $300,000, but real money. And that's assuming you're in the cheap version of your target date fund. A lot of people are in the retail share class of the same fund they could hold in institutional shares for a third of the price. I'm not anti-advisor, by the way. I'm anti-invisible fees. If you have a financial advisor who charges 1% of assets under management per year, that's roughly $170,000 in lost compounding on a $200,000 starting portfolio over 30 years. If they're adding meaningful value, behavioral coaching, tax optimization, estate planning, that 1% might be worth it. If they're rebalancing a portfolio twice a year and sending you a quarterly newsletter with a stock chart, that's an expensive newsletter. Know what you're paying and what you're getting. The bucket, hole 2, slow leak, 30 years, $300,000, gone. Here's the part that never makes it into a standard retirement calculator. You now know that bad timing in the first 5 years can destroy a portfolio, and that fee drag over 30 years can eat a third of your wealth. But both of those are problems that happen before and during retirement. The next hole, Social Security timing, is a single decision you make once, that you generally cannot reverse, and that the vast majority of Americans get catastrophically wrong. I built a digital book called The Exit Code, specifically because this decision and 3 others like it are where the real money lives, and nobody explains the math in plain language. It's 8 chapters built on 50 years of actual retirement data, not opinion, not what worked for my cousin, real math. One of the things it covers in detail is what I call the dynamic withdrawal method, the replacement for the 4% rule that adjusts based on what the market is actually doing rather than what it did in 19%, 26. Another section covers the Social Security bridge strategy, how to wait until age 70 to claim the maximum benefit without going broke between 62 and 70. Because that gap is where most people surrender the game. The book is less than the cost of dinner out through the link in the description. The math inside it is worth more than any single investment decision you'll make this year. Now, hole number 3. One academic study concluded that claiming Social Security before age 70 can mean a reduction of over $182,000 in potential lifetime benefits. Despite this, data shows over 90% of claimants start receiving benefits before turning 70, with more than 20% doing so at age 62. 20% of retirees claim Social Security at the earliest possible moment, age 62, locking in the lowest possible monthly payment for the rest of their lives. Let's put a number to that. If you retire at age 62 in 2026, your maximum possible Social Security benefit would be $2,969 per month. If you retire at age 70 in 2026, your maximum possible benefit would be $5,181 per month. That's the same government program, the same benefit you earned, the same trust fund, just claimed 8 years later. The monthly difference is $2,212 every single month for life, adjusted for inflation every year via the cost of living adjustment. Claiming Social Security at 62 reduces your monthly benefit by as much as 30% compared to your full retirement age. And your full retirement age isn't 65 anymore. For those born in 1960 or later, full retirement age is 67. So claiming at 62 means claiming 5 full years early, not 3. Your benefit increases by about 8% per year for each full year you wait beyond your full retirement age. For someone with a full retirement age of 67, at age 70, you'll receive about 124% of your full benefit. Think about what an 8% guaranteed annual increase means in an environment where 10-year Treasury bonds are paying around 4%. The Social Security Administration is essentially offering you a guaranteed 8% return on your decision to delay. There is no investment product you can buy that offers 8% risk-free, and yet over 90% of Americans don't capture the full benefit of this. Why? Because they're afraid. They've heard that Social Security is going broke. They've heard that they'll die before they break even. Let me address both of those. The Social Security Trust Fund question. The 2024 Trustees Report estimates Social Security will be fully funded until 2033 and able to pay 100% of benefits to current and future retirees. Thereafter, absent any changes from Congress, benefits could be cut by 21%. A potential 21% reduction to a future benefit is not Social Security is gone, and politically, cutting benefits to people who are already retired is roughly as likely as Congress passing a law requiring everyone to eat broccoli. It has never happened, and it would end careers. The fear of Social Security collapse is real, but it is not a good reason to lock in a 30% permanent reduction today. The break-even question. The break-even point for claiming at 62 versus 70 is approximately age 80. If you live past 80 and a 62-year-old in reasonably good health has a meaningful probability of doing exactly that waiting paid off. Studies have shown around 7 in 10 retirees end up with more lifetime income by claiming at 70, 7 out of 10. Those are not close odds. Those are the odds of a weighted coin. Now you might be thinking, I can't wait until 70 because I need the income right now. That's the real objection, and it's fair. The answer isn't just wait and be poor for 8 years. The answer is a strategy called the Social Security Bridge. You draw down your portfolio during the delay window at a lower rate than you would if you were relying on Social Security, because you're planning to replace that income permanently at a much higher level later. Every year you delay Social Security reduces the amount your portfolio must provide, directly reducing your withdrawal rate during the high-risk window. A $1,000 per month Social Security increase is equivalent to having $300,000 more in portfolio assets at a 4% withdrawal rate. $300,000 right there. That's not a projection, that's math. I want to introduce Marcus now. I mentioned him at the start. Marcus was a client of a financial advisor, friend of mine who retired in 2008, the absolute worst possible year to retire, smack into the second largest market crash in American history. His portfolio dropped over 30% in his first year of retirement. By every traditional model, Marcus was supposed to be in serious trouble. But Marcus had done one unusual thing. He had spent 2 years before retirement building a cash buffer equal to 3 years of expenses, and he had not claimed Social Security at 62 like most of his peers. He was 63 in 2008, and he decided to keep drawing from cash during the crash, while his equity portfolio technically existed on paper in a terrible market. He let it sit. He didn't sell. He didn't panic. His cash bucket bought him time while the market recovered. By 2012, his equity portfolio had recovered to roughly its pre-crash level. Marcus retired at 63 and waited until 70 to claim Social Security, drawing on his bridge strategy for 7 years. His monthly Social Security check at 70 was $4,300. His neighbor, who claimed at 62 to lock it in and sold equities at the bottom of the 2008 crash to cover living expenses, died at 82, still managing a depleted portfolio and collecting $2,100 per month. Same neighborhood, different systems, same age, wildly different outcomes. Now let's talk about the fourth hole, because the bucket still leaks even if you fix the first three, and here's why. The whole retirement withdrawal conversation is dominated by a single number, 4%. Bill Bengen published his research in 1994. That's 32 years ago, and a generation of financial planning has been built on a static rule created from historical data ending in 1995, during a period of extraordinary bond yields that no longer exists. Bengen introduced the 4% rule in a 1994 paper published in the Journal of Financial Planning, based on historical U.S. stock and bond returns dating back to 1926. His research found that a retiree withdrawing 4% of a balanced portfolio in year one and adjusting for inflation each year after would not run dry over 30 years. The figure was rounded down from 4.15%, and it stuck as a default guideline for an entire generation of retirement planning. Here's the thing about 4%. Bengen himself has since revised the figure upward, most recently suggesting 4.7% as the worst case historical safe withdrawal rate. He told CNBC in 2025 that retirees who stick with 4% are likely cheating themselves a little bit of the retirement they earned. So you have a situation where financial advisors are still quoting a number that its own creator says is outdated. And on the other side, newer research from Morningstar suggests the opposite problem, that for some portfolio allocations, 4% might still be too high given current valuations. Morningstar's new safe starting withdrawal rate is 3.9% for a balanced retirement portfolio. Flexible withdrawal strategies like guardrails or required minimum distributions can increase starting rates to about 6%. The range between 3.9% and 6% is not a rounding error. On a $1 million portfolio, 3.9% is $39,000 per year. 6% is $60,000 per year. That gap is $21,000 annually. Over 20 years of retirement, you're either taking $420,000 out of that portfolio or paying yourself $420,000 more than you needed to, depending on which static number you picked in year one and then never updated. A static rule in a dynamic world. A fixed withdrawal from a fluctuating portfolio. The bucket drains differently every year, and everyone is told to pour at the same rate regardless of what the water level looks like. The traditional approach of withdrawing a fixed percentage each year doesn't account for market conditions. Flexible withdrawal planning means reducing what you take in down years and increasing it in strong years. Even small adjustments, pulling 3.5% instead of 4% during a bear market, can significantly extend a portfolio's life. Now, let me add one more dimension to this that the mainstream retirement industry barely talks about. Healthcare costs before Medicare. This is a specific problem for people who retire before 65, and 70% of Americans retire before they are eligible for Medicare. 70%. Which means most people who retire face a healthcare gap. Without a subsidy, ACA marketplace premiums for a 62-year-old typically run $1,000 to $1,800 per month in 2026. That's the full price number. At $1,500 per month, that's $18,000 per year per person just in premiums before deductibles, copays, and out-of-pocket expenses. For a couple retiring at 62, you're looking at something in the range of $36,000 per year for 3 years. Until Medicare kicks in, that's over $100,000 that most retirement plans don't account for. And in 2026, the enhanced ACA subsidies that made this manageable for millions of Americans expired. Many people qualified for a subsidy to help pay ACA premiums based on household income. But the subsidies expired at the end of 2025, and the outcome of efforts in Congress to restore them is uncertain. The mainstream retirement calculator on your bank's website does not model this. It asks you when you plan to retire and then applies a historical average return. It doesn't model sequence of returns risk in the first 5 years. It doesn't subtract fee drag from your compounding. It doesn't show you the difference between claiming Social Security at 62 versus 70. And it absolutely does not model 3 years of 4-figure monthly healthcare premiums before Medicare starts. The tool your bank gives you for free is missing 4 of the most expensive line items in your retirement. Time for a small but necessary reality check. Here's the most honest thing I can say about the people I've watched navigate retirement well versus the people I've watched struggle. The ones who did well were not necessarily smarter or richer. They were more systematic. They treated retirement as an engineering problem, not a number. How much do I need to get there is the wrong question. What is my income strategy when I arrive is the right question. Let's run a quick mini case study. Take Dave, 62 years old, about to retire with $600,000 in a 401k, mostly in actively managed mutual funds, averaging 1.2% in expense ratios. He's planning to claim Social Security this year because he heard it might be cut. He's planning to withdraw 4% per year, which gives him $24,000 annually, plus his Social Security check of about $2,200 per month at 62. Total retirement income plan, roughly $50,000 a year. On paper, that looks okay. But let's look at what's actually happening. Hole number 2 first. Dave's fund fees of 1.2% on a $600,000 portfolio cost him roughly $7,200 a year in direct fees. But more importantly, they're eroding his compounding base. Had Dave been in index funds at 0.06%, the fee savings alone over 15 years of remaining growth and withdrawal would add roughly $130,000 back to his ending balance. Hole number 3. By claiming Social Security at 62 instead of 70, Dave is locking in a permanently reduced benefit. If his full retirement age benefit would have been $2,800 at 67, and he could have gotten $3,500 at 70, he's leaving over $300 per month on the table forever. Over 20 years of retirement, assuming he lives to 82, that's $72,000 in lifetime Social Security income he surrendered. And Social Security doesn't have fee drag. It doesn't have sequence risk. It's inflation adjusted. It's the most undervalued asset in most retirement portfolios. Hole number one. Dave retires in a down market in year one. He withdraws $24,000 out of a portfolio that drops 15% in year one. He's now selling shares at a discount to fund his lifestyle. His effective portfolio after the first year is roughly $490,000, not the $576,000 he'd have if he hadn't withdrawn a dime. Recovery takes years, and it's happening on a smaller base. Even if the average annual return over time is favorable, early losses can compound the problem because withdrawals lock in those losses, leaving less capital to benefit from future gains. Add the healthcare gap. Dave retired at 62. Without a subsidy, he's looking at close to $14,000 per year in health insurance premiums until Medicare at 65. 3 years, $42,000. His retirement plan didn't budget for this. Total estimated damage across all 4 holes over a 20-year retirement, north of $350,000. Not because Dave made one catastrophic mistake, because he made 4 small, ordinary, incredibly common mistakes that the retirement industry actively discourages you from thinking about simultaneously. 2 things that financial institutions have told generations of Americans with complete confidence that deserve mockery. 1, just dollar cost average and stay the course. Genuinely useful for the accumulation phase. Completely ignores the fact that once you're withdrawing, the math inverts. 2, will manage your portfolio for 1%. You just relax. That 1% on a $500,000 portfolio compounding over 20 years is real money, and the portfolio manager is almost certainly underperforming the S&P 500. So what do you actually do? 3 practical takeaways from everything we've covered, and these are specific to this exact problem, not generic advice. Takeaway 1, run a fee audit on every single fund in your 401k or IRA. Go to the fund's website, find the expense ratio number, and if it's above 0.3% for a broad market index fund, you are overpaying. The average equity index fund in 2024 was 6 basis points. 6. You are allowed to hold a 3 basis point S&P 500 ETF. You're allowed to ask your advisor why their recommended fund charges 30 times more than the Vanguard equivalent. Silence on that question is an answer. Takeaway 2. Do not make your Social Security claiming decision based on fear, impatience, or default. Do the break-even math for your specific benefit amount and your specific health situation. If you are in reasonable health and have any means of bridging the income gap between retirement and age 70, whether through portfolio withdrawals, part-time work, or a spouse's income delaying, is almost always mathematically correct. Studies show around 7 in 10 retirees end up with more lifetime income by claiming at 70. 7 out of 10 is not "it depends." It's probably wait. Takeaway 3, build a cash buffer before you retire. 1 to 3 years of expenses in liquid, low-risk assets, separate from your equity portfolio. Not as a permanent allocation, as a shock absorber for the retirement red zone. If the market drops 30% in year 1, you do not touch your equity portfolio. You live from the buffer. You let the equity recover. This single decision protects against the most lethal form of sequence risk and costs you almost nothing to implement if you start building it 2 to 3 years before retirement. Marcus figured out all 3 of these, mostly by accident and partly by instinct. He resolved just fine. His neighbor did not. The distance between their outcomes was not luck, intelligence, or income. It was the presence or absence of 3 systems, and the willingness to not claim the money early just because it was available. The retirement system in America was built for a world of pensions, short retirements, and predictable inflation. None of those things exist anymore. Nearly 45% of all Americans who retire at age 65 are likely to run out of money before they die, according to the Morningstar Center for Retirement and Policy Studies. That is not a small risk. That is essentially a coin flip for the most basic objective of retirement, not running out. The information to avoid that outcome is freely available, including in this video. The problem is that the information is scattered across academic papers, tax code footnotes, and fee disclosures written in type so small they require a microscope. I read those documents. That's literally my version of fun. You shouldn't have to. Lazy investing built more fortune than crypto memes. And that's not a complicated thing to do. A 3 basis point index fund, a social security decision made with a spreadsheet instead of anxiety, a cash buffer, and a withdrawal rate that actually adjusts with market conditions. That's it. That's the whole system. Your financial advisor probably won't walk you through all 4 simultaneously because doing so puts his fee under a spotlight. The retirement calculator on your bank's website won't show you the fee drag because the bank built the calculator. The government hasn't simplified Social Security decision-making because complexity keeps people from optimizing. The system isn't conspiring against you. It's just indifferent to you in a way that happens to be expensive. Pay attention. End of script.